And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
And welcome to my podcast. So, today the market was like watching paint dry once again. The problem, we don't have the institutions. That's the biggest problem. We've got to get the institutions back in this market. But we got to get the volume back. That's the biggest thing. And we don't have that. If you look at today's action, they say it was like watching paint dry. The problem is the machines. They keep kicking in. And you need at least a 5 to 10 basis point jump in either the 2-year or the 10-year. We're not getting that. When both the 2-year and 10-year are dropping, and the machines with their software, their automated trading system that's in control, which is really dangerous, and I'll go over the consequences in a moment. The machine is set up to buy tech, set up to buy discretionary and semiconductors. So that's when both the 2-year and the 10-year yields are dropping. And the machines set that up. It's amazing. Now, when both the 2-year and the 10-year yield are rising, then the machine sets up a trade to sell tech, buy value, buy staples, buy utilities. And when the 2-year yield's dropping faster than the 10, then you buy banks. You sell tech. So, even though these machines have given us severe consequences, if you know what you're doing, you understand how to trade, how the system works, there's no problem. You just have to tweak what you're doing because we're working with machines instead of human beings, because we've had severe consequences because of this. There's no volume. There's no money in the market. I mean, just think about again, for the last 10 weeks, including this week, machines and their automated software, their trading programs have been driving this market. And the consequences are terrible. Example, 80% of the daily volume, 80% of that daily, the institutional money rather, between 10 and 12 trillion is gone. Gone. They just left behind 1 to 2 trillion. The money's gone. Also, the result, the consequences of these machines is the New York Stock Exchange daily volume has dropped from 11 to 12 billion to 9 billion. Are you nuts? We got to get that volume back. If we don't get that volume back and we don't get these yields stabilized, getting the credit conditions to improve, volume, the big one, to return, and the Fed has got to start sending out some good messages. The problem, the Fed is sending out messages that, hey, we're not going to cut rates. We're not going to raise rates. We have no direction right now. I mean, that's the message that you're getting from the new Fed chair. So that's why, again, when you have the institutions, the biggest institutions, BlackRock, Vanguard, State Street, which, by the way, is the spiders, Fidelity, T. Rowe Price, when they're out of the game, and they take all that money with them, and whose money's that? Well, GM pension funds, Ford pension funds, all the teachers' pension funds, they pull that money out. And when that money's gone, your action's gone. So you have severe consequences when these machines kick in. Breath collapses, negative breath. We have terrible negative breath. And the big problem is, one of the biggest consequences is that we have trapped now the yields. The 10-year and 2-year yields are trapped take the 10 years, trapped between 4.52 and 4.56. The 2 years trapped between 4.17 and 4.20. Now, what the hell caused all this to occur? Where the institutions decided they're not going to play anymore. They took their ball bat, which is money, and went home. And now that forces the machines to be triggered, and every trade is mechanical. And one of the worst things about the trade, if you look on your chart, like if you look on what we have as our Pro 3 chart, you can see during the day, if you have a candlestick, today's candlestick, and let's say your stock's going up, and it went from, let's say, I don't know, $50 to $60, and it gives it back. It gives it back. People get frustrated. They don't know what's going on. And what's worse is, let's say it goes from $50 to $60 or $50 to $55, from the bottom of the candlestick to the top. You're sitting there, you think you're making money, you add on some more shares, and then all of a sudden it pulls right back. Most all of it, or half of it. And unless you know what you're doing and know how to trade a market that's controlled by a machine, every time your stock goes up, it's natural to say, well, I'm going to buy more shares. When you do that, you're going to get hurt, because by the end of the day, it contracts. That's one of the consequences of these machines. So it's all mechanical. It's all yield driven. And the 2-year broke. When the 2-year broke above the danger zone of 4.5, that's when this all started to happen. So that 2-year yield is the institutional fear gauge. So these institutions like BlackRock and Vanguard and T. Rowe Price, managing all this money, the 401ks, pension funds, savings, all this money, $50 trillion. They use a gauge, okay? It's called the 2-year gauge. And when that 2-year yield got above that 4.5, bam, they panicked. And that's when the machines start trading, because institutions pull their money out. So when Vanguard and the rest of them see that happening, going above that 450, they start yanking the money out. So that's the problem. Because again, institutions saw danger. Higher short-term funding costs. They saw tighter credit conditions for their clients, higher risk, little visibility. And that's when they said, hey, we're out of here. And so yields stabilize. They want yields, the 10-year Treasury yield, to be at least at 4.25 or lower. Are you kidding? Were you nuts? We're above 4.50. We're in a danger zone. So that's why the computers are in. Institutions are out. They took their money out. And now the computers decide the stock setups. It's easy to trade if you know what you're doing. But the people who manage your money, they don't know what the hell they're doing. So that's a big problem. And the 10-year is a valuation gauge. So when it broke above that when it started to first break above that 4.40, that was a huge red flag. Because again, they saw lower equity valuations. They saw higher discount rates. They saw pressure on the tech multiples, pressure on corporate borrowing, that panics them. Now remember, these institutions, BlackRock and so forth, they're managing this $50 trillion. Remember, that $50 trillion, all the savings, all the 401ks, they're managing all that for folks. So when they see that kill zone get hit, that when we started to go to 4.4, they panicked. But when we got to 4.5, they really panicked. And they said, we're out of here, and the machines automatically kick in. This has been 10 weeks now. And it's not getting better. But for us, we're doing just fine because we know how to trade the market. This particular kind of market. But see, if you were watching CNBC or Bloomberg, they're not going to tell you any of this. The managers manage your 401k. They don't deal with that because they think, oh, we buy and hold. We buy and hold. Another thing they saw, that's another consequence of this, is credit conditions have tightened terribly. Try to go get a loan at the bank. Oh, the guys on Wall Street who take care of public companies, but if you own a business, let's say you own a restaurant in downtown Sarasota, and you want to add on and you want to get a loan, good luck. You want to add another 20 chairs, good luck. There's no money. So again, and what we're seeing is these regional banks with these big loan losses. They're going up and up and up. That's become a very severe problem. Also, what we're seeing now, commercial loans. I know we keep hearing about commercial loans, and nothing happened. Oh, you wait and see. Commercial loans are very, very bad shape right now, very bad. So the Fed has froze the market with this new guy. Now, this new guy, remember, they fired the old guy, Powell, because he wouldn't cut rates. Well, this guy they have, this dope, this new guy, he keeps repeating the same message over and over and over, which is a terrible message. He's not going to do any rate cuts soon. He's not going to, no policy shift. How do you take over the Fed? You wanted to fire the old guy because he wasn't doing what you wanted him to do and all his policies were bad. You bring the new guy in, and the guy you're going to follow, the new guy's following, you threw him out, he's following the same policies. He's not changing them. So they wanted to fire Powell to bring Warsh in, but Warsh is using the same policies that Powell has. And you want to know why the market, the machines are trading? I mean, you want to know why, again, the institutions have taken out that 10 to 12 trillion, leaving 1 to 2 trillion behind, where now machines click in and set up trades. You just got to know how to trade. You just got to know how to identify what stocks they're going to trade. So the Fed's new chair, he's not helping this mess at all. And it's only a mess if you don't know what you're doing. You don't know how to trade a market that's generated by computers. Or not the computers, generated by the software they put on the computer. So the consequence is now institutional money is out, market's really frozen up, and until that 10-year stabilizes, it's got to stabilize at 4.25 or less. That 2 years got to be really at 4%, but ideal is under 4%. That's not going to happen. Because look what the Warsh is saying, the Fed president, the chair. He's saying no rate cuts, no change of policy. But they fired the guy. I know I hate to keep repeating myself, but when I hear myself, I go, this, how this could be? They fired the guy because he wouldn't change policies. they're using his policies. Now the volume has dropped from 11 to 12 billion shares, to 9 billion shares. That's insane. A 17% decline. And you want to know why we have a market? It's like watching paint dry. And that combination has changed the entire market. This machine trading and all the money leaving, the institutions leaving, and the machines have totally changed the stock market. And if you don't know how to adjust to it, you're going to get hurt. But we've been working the market for the last 12 weeks. We're doing just fine, thank you, because we know how to adjust to it. We've only been doing it for nearly 50 years. So, again, what we're doing every day is identifying, okay, when we start trading, we watch the yields like a hawk. And we also are watching like a hawk the leverage. The leverage is being used in the stock market. The amount of money that's being borrowed to trade stocks is nuts. People are going in with $100,000 to borrow $400,000. Watch what happens. We never had, I think we're at what, 1.4 trillion? Are you kidding me? Leverage? 1.4 trillion. Margin debt leverage. You know how serious that is? You think the market got hit hard when we had margin debt leverage back with the dot-com and the housing con. My God, I got to see. Willie, maybe you can find for me what was the margin debt in 2001 or 2008. Both those. Nowhere near this. So, and that's the other thing. That when you have the skill to sell stock short as well as buy stock, sell, buy, you got to know how to sell short. Once you know how to sell short, and it's so simple to read charts, not the ones Wall Street give you. We built our own charts to make it simple. So before the dot-com, there's 280 billion. That's it. We're at 1.4 trillion. 280 billion, and we had a crash, the dot-com crash. Well, I wonder what it was with the 2008. Check that. 380 billion. So think, 2008, 380 billion was leveraged. 380 billion. Are you kidding? We're at 1.4. We're borrowing 1.4 trillion to trade stocks. When the dot-com crash was 280 billion, and when the housing finance blew up, that was 2008. It was about 350 billion. We're at 1.4 trillion, and there's only 6 stocks. They're holding up the whole stock market. 6. And they're getting hammered right now. There's 4 stocks. If they break, and I'm going to show you let's see if I can get my chart up here. And then, if you take, we're short these. ASML. There's 4 companies that make machines that make chips. Okay, that's ASML, LRCX, CLAC, and AMAT. They're trying to hold them above the support of the 50-day moving average. Now, we have a nice short position on it. We made some nice money start to short it, but we're really going to make some real money if it breaks the 50-day moving average. If those break the 50-day, you watch what happens to this market. That's where all the money, the institutions that took 10 to 12 trillion out of the market, they have about 5 trillion in those 4 stocks parked there. Think about that. Now, and then if you take the stocks, the companies that buy those chip machine makers from those four companies that build them, there's Taiwan Semi, Intel, and MU. They are the biggest buyers of those four chip making companies. Everything is around those stocks right there. It's holding up the whole market now. I'm talking about 700 stocks. When you put in your NASDAQ stocks, your S&P, and your Dow, about 700 stocks. And if they break that 50-day moving average, that's what I'd be watching. That's what we're here at the gang. That's what we're doing. We're watching that, because if we can catch that. Now they're going to. I'd say they're going to be around that 50-day moving average for a while. I don't think it'll break the first time. I think they'll try to. Remember, they always try to rally it back up. So the test is not at the 50-day moving average. The test, for example, on if you look at AMAT, the test is at the top, at where their high was around 70, around 7. I think it was around 708, something like that. So that's it. That's what's going on for this Friday. And I'm certainly not trying to discourage you. I'm trying to tell you the truth that Wall Street doesn't tell you. So we got in this mess, okay, because of the Fed. Fed never does anything right. And so you should never be in a position when you're investing in stocks where the Fed can hurt you, or any policy can hurt you. Any noise can hurt you. And there's only one way you can do that: if you know how to sell short as well. It's like buying a car with no reverse. Who would buy a car with no reverse? Who would go into a stock market and start trading their money with no reverse? Okay, so that's what's going on today, Friday. And I hope you have a great weekend. And the best information I can give you is every morning, watch those yields, the 10-year and the 2-year. And I'll finish with this, give you a little bit of help. I think I put my list up here for you. Okay, so when the 10 or 2-year, when both the 2 and the 10-year yields are dropping, you buy tech, discretionary, and semiconductors. When both the 2-year and 10-year yields are rising, you sell short. See, that's where it comes back in. You got to know how to sell short. Tech, you buy value, buy staples, and buy utilities. So we can help you with all this, all right? We can show you how to sell short and what a difference that makes. Then all this nonsense doesn't mean anything. It's just another day at the office. I'll see you on the charts.